Hello, and welcome to the fourth quarter economic and market update hosted by the Investment Committee here at Curo Private Wealth. I am Atrisa Roberts, COO and partner, and I am joined by our illustrious Investment Committee with Ann McCabe, our CEO and partner, Xander Cochran, our investment and planning associate, and financial advisors, Manny Carranza and Drew Culver. Thank you so much for joining and listening in today. So we want to start, as we always do, with a review of where we are so far here in 2024. So this year we've seen inflation move toward the Fed's 2% target, with our headline core consumer price, index, which fell to 2.4% by September, and the Fed's preferred inflation index, known as the personal consumption expenditures price index, down to 2.2%. This has led the Fed to begin interest rate cuts, which started in September with a cut of 0.5 percentage point, with additional cuts expected through the end of the year, maybe 1 to 2 more additional cuts. Growth in consumer spending is slowing, but is maintaining a modest pace, with much of the slowing represented in lower income households, while higher income earners could continue to spend. There has been concern over the unemployment rate moving higher and triggering the SOM rule. Now, for all of those who may not be informed, the SOM rule, which was introduced by and named for Claudia Somm, states that a recessionary period is starting when the 3-month moving average of the national unemployment rate rises by 0.5 percentage or more from its 12-month low. This rule was triggered in July, causing some concern, but the current market cycle seems to be the exception to that rule, as recession does not yet appear to be imminent. Market volatility also increased in the third quarter, but all asset classes in the market have found themselves in positive territory by the end of Q3. Led by U.S. stocks. Now, while the tech sector has slowed, we have seen a pretty significant rally in utilities, which have played catch up through the end of the quarter. And we have seen the short-lived increase in market volatility, which was kicked off in August, subside as election day approaches. But all in all, 2024 has been off to a remarkable start through the third quarter, with 43 record all-time highs in the S&P 500 index through the end of Q3. So taking a look more in depth into our market returns by asset class, you'll see through the end of the quarter, all asset classes now find themselves in positive territory. This again is led by U.S. stocks, with utilities specifically rallying over 20% during the quarter. The pattern sections in each of these bars on the graph show returns for just the third quarter. And as you can see, bond performance, which had lagged through the first half of the year, increased in Q3 as the Fed started to make interest rate cuts. This has also led to U.S. real estate having an exceptional quarter, as well as declining interest rates sparked the expectation that we'll see some easing in the U.S. real estate market. So all in all, we are seeing a really good performance year across all asset classes and sectors in your portfolios. So now I will turn it over to Manny, who will dive deeper into some more economic data.
Thanks, Atrisa. So the slides that I'll be going over just talk about how the interest rate cutting cycle can affect different asset classes. So in 2022, the Federal Reserve began aggressively hiking interest rates, but they paused interest rate hikes last year as inflation got closer to the Fed's target of 2% and the labor market softened. Rate cuts began in September. So on the gray area of this chart, you can see the range of market expectation for interest rates. There's still some uncertainty around how aggressive rate cuts are going to be, but the FOMC projects that the Fed fund rate will be reduced by another 0.5 percentage point by year end, and more cuts will continue in 2025. Here on this slide, we're taking a look at the amount of money in money market funds since 2004. As you can see, as of now, we're currently at an all-time high of 6.3 trillion. This growth can be attributed to how high interest rates have been and how much interest rate we've been able to earn on our cash. And moving forward, the expectation is that interest rates are going to continue to be reduced, so it may be a good time to revisit your cash holdings inside and outside your portfolio. So what this table shows us here is how much cash how cash and bonds have performed in the 12 months following the beginning of a rate cutting cycle since 1980. At this time, it looks like the economic outcome of the Federal Reserve's actions of increasing interest rates will be a soft landing. So what a soft landing means is that the action that the Federal Reserve has taken by raising interest rates has slowed down the economy enough that it won't cause a recession. With the expectation of a soft landing, on average, treasuries tend to outperform cash and other bonds, even high yield bonds, and cash has typically been the worst performer. When the Fed starts cutting rates historically, bonds have outperformed cash in the following 12 months. Again, revisiting how much you've saved in cash could be an opportunity for you in finding a way to better invest that money. Now I'll pass it off to Drew.
Thanks, Manny. So this slide right here shows the current price to earnings ratio of the Russell 1000 growth minus the Russell 1000 value. So you can see currently we're sitting at a 13.2, which is over double the average of the indices when you exclude the tech bubble. We certainly saw valuations lower considerably in 2022, which was a rough year for the markets, but ever since, growth has certainly roared back and carried a lot of the market returns ever since. And as a result, things are a little expensive on the growth side. So this chart right here shows how value does relative to growth when value stocks have underperformed growth stocks by a 25% margin, which we actually saw in the third quarter. So you can see 12 months following that threshold being crossed, on average, value has outpaced growth by 16.5%, 8.4% over 6 months, and 2.8 shorter over 3 months. Following an election, we also see value do quite well relative to growth stocks also. So both very good reasons to start looking at value stocks as an option in your portfolio. So taking into account some of the things that we just went over, some of the themes that we're implementing with our Curo models are decreasing our overweight slightly to stocks and moving that more towards bonds as the Federal Reserve continues to cut rates. We still do have a slight overweight to stocks, but we're seeing that come down ever so slightly. We've also increased the exposure to value versus growth. We still have a healthy amount of growth within the portfolio, but as we just went over, we do believe that there is opportunity in value stocks moving forward. We've also decreased exposure to small cap companies to be closer in line with our benchmark. Still do have a slight overweight, but did notch that down ever so slightly. And this chart right here shows if you were invested $10,000 into the market back in 1949, how that would have returned if you were fully invested into the S&P 500, if you only invested during a Republican presidency, and only invested during a Democratic presidency. So we don't want you to be fearful of one candidate winning or another. The real important part here is clearly to stay fully invested through the ups and downs, and you'll be much better off long term, we believe. So on that note, I'm going to hand it over to Xander.
All right, so I want to start off looking at the economic dashboard as we like to look at every quarter. And so some of the shifts that we've seen within the past quarter I'll go through. First one is for monetary policy, which is really what the Federal Reserve Bank is doing with interest rates. In September, they cut interest rates by 0.5 percentage point. And so we've seen this dial move a little bit more towards the green or positive territory over the past quarter. usually as lower interest rates from the Federal Reserve Bank is accommodative for the economy, and is also usually good for both stocks and bonds. Next, we have the manufacturing sector. This has moved a little bit lower in the gray territory, just as manufacturing conditions have struggled a little bit more. We saw a little bit of a comeback in the spring, but over the summer and fall, manufacturing has struggled a little bit more, which is why it's pushed a little bit closer to the red or negative territory. Next, we see the consumer, and overall, not much of a change in the past quarter. So that's stayed at the same point on the dial there. So we see a relatively strong consumer, but we've definitely seen an uptick in delinquencies as spending is a little bit harder for those at the lower side of the income earners, spending more of their expenses on credit cards and having a harder time paying off credit cards and other debts as well. But overall, still relatively strong consumer. Next, we have the housing market, and we haven't really seen much of a change here over the past few quarters, so that's stayed towards the negative end of the dial here. We have seen interest rates for mortgages start to come down a little bit as well, although we've seen a reversal in the past few weeks. But even with interest rates starting to come down a little bit, you still have a imbalance of supply and demand for houses right now, as supply remains low, especially those with a nice low interest rate from a few years ago. That gives us a lock-in effect, and a lot of those homeowners are hesitant to go out and sell their house because it would mean that they'd have to get a much higher interest rate if they were to sell their house and buy a new one. And then lastly, we have the labor market. This dial has moved down a little bit. It was in the line between the green and the gray, and it's moved a little bit into the gray or neutral territory. That's been with a uptick in the unemployment rate and with a triggering of the SOM rule, as Teresa had mentioned earlier. And so there being some concern there, but overall, still seeing a strong labor market that's been continuing to flow through in the economy. So one thing to highlight here is really just looking at inflation one more time, of as inflation has come down to close to the Federal Reserve Bank target of 2%. Now, the chairman, Jerome Powell, has said not necessarily to call a victory lap on inflation just yet, but we are looking like we're heading that way with headline CPI inflation at 2.4%, so getting close to the target there. Now, there are certain pockets of inflation that we continue to see that are much higher, like eggs and like in auto insurance right now, that has been much higher this year. However, we see some other sides of the inflation story that's come down, particularly energy has come down this year, balancing that out. So with inflation coming down, which is nice to see, that means that wages are continuing to outpace inflation. So as the labor market remains relatively robust and market participants are able to earn their wage, and now they're able to keep a little bit more in their pockets, just as their wages are outpacing the increase in prices. So I've seen over the past year plus this be back into positive territory, which means the consumer now has a little bit more cushion when it comes to spending, and they can either spend a little more or they can save a little bit more as well, which is healthy for the economy. So looking at the personal savings rate, we've seen that over the past couple of years, that has moved higher. Just as consumers have a little bit more wiggle room in their budgets, can save a little bit more. We've definitely seen that, which is good and healthy to see recovery there off of some pretty low numbers from a couple of years ago. However, we're still not quite to the level of a historical average over the past several decades. So we anticipate to see that continue to move higher for a healthy economy moving forward. And one last slide on the economic side of things. So this is looking at economic productivity. And we saw a pretty sharp decline a few years ago after the wake of the pandemic, a little bit probably from people working from home and just so much disruption during the pandemic. We saw productivity decline a bit, but we've seen that in the past over a year now, see that pretty sharp increase there in productivity. And that's really not including the benefits of artificial intelligence. We've seen a lot of infrastructure spending on artificial intelligence, but not too much in ways of economic productivity. And if we're able to get a little bit more productivity over the next few years as AI really starts to have more of a benefit, we could see an continued increase in economic productivity, similar to what we saw in the late 90s to early 2000s with the increased economic productivity we saw from the internet. So to be determined to see if artificial intelligence really is able to live up to the hype, but is something that could be good for years to come. And with that, I will switch it over to Anne McCabe.
All right. Thanks, Ander. So as we always like to do, we like to close by zooming out quite a bit. So this whole presentation so far has been talking about market activity and economic activity in 2024. But in this chart, we are reminding folks by going back to 1900 what the S&P 500 has done since that time. Despite, as you can see, many, many challenges, whether those be economic crises or wars or with COVID being a global pandemic. The point of this chart is to remind us all that pretty much every year we can tell you a reason to not be invested. And yet, if we zoom out back to 1900, we see the S&P 500 really going up and to the right. So just last week, this bull market turned 2 years old. And as a reminder, definition of a bull market is when we go up 20% off a low. So that low was hit back in October of 2022. And even if you think about the past couple of years, there have been many reasons to not be invested, many reasons to be nervous about the stock market, whether that be inflation or, many geopolitical issues or interest rates being high, and yet the market has been on a tear. So we really want to emphasize and reiterate the importance of staying invested, the importance of remembering that most of us are long-term investors, and for any short-term needs that we have, that money should be parked in cash, nice and safe. But for any goals that we're working on that are longer term, we believe that the best place to build wealth is by having a diversified portfolio, which includes having stocks in there. So we are going to finish by a reminder of our philosophy at Curo and where we like to live and where we like to work with clients, which is where what matters to them comes together with what we can control. And so we always want to make sure that our financial plans take into account our families, our occupation, recreation, so the things we want to do, like our bucket list items, and taking the assets and the money to understand how we accomplish those goals in our life. And then to also always remember to focus on what we can control and really try to spend as little energy as possible on those areas that we cannot control, which we have listed here on our visual. So thank you so much for taking the time to watch this and tune in. If you have any questions, please feel free to reach out to us. You can always send an email to info@curoprivatewealth.com. You can find us online. We are putting out a lot of educational content out there for you all. So please check us out on all the social media platforms as well. Thanks again for tuning in, and we look forward to speaking with you all soon.